Good afternoon. Thank you for joining us today for Kolibri's fantastic Q1 and their current bank line increase, as well as operational update. Kolibri Global Energy trades under the ticker symbol KEI on the Toronto Stock Exchange and KGEIF on the OTCQX. With us today from the company is Wolf Regener, President and CEO, and CFO Gary Johnson. We'll touch on the highlights of the quarter and open it up to questions. Please enter your questions in the Q&A box. The presentation may contain forward-looking statements. Welcome, Gary and Wolf. I will turn it over to you guys to touch on the highlights of the quarter, if you'd like, and then we can go into Q&A.
Sounds good. Thanks for getting everything set up. Welcome, everyone. Thanks for joining us. Most of you know everything, so I'm not going to go through the whole presentation. Do have to touch on the forward-looking information, and then the disclaimers about non-GAAP, etc. So those are all in our presentation, and most of this, presentation can be found on the website. I think nothing has changed here on management, so everyone knows who we are. Same on the board of directors. And I'll pass it over to Gary with our first quarter results to kick us off, and then we'll go through some of the things that have recently changed since our last webinar, just as a brief update. So take it away, Gary.
Hi, everyone. Thank you for joining us. So I'm just going to go through some financial highlights for the first quarter. If you have any additional questions, we can do those at the end of the webinar. So our average production for the quarter was just under 1,300 barrels BOE per day, which was a 200% increase over the first quarter of just over 1,000 BOE.
3,100.
3,100, yeah.
I'm sorry. Net revenue was $14.3 million, which compared to $5.5 million in the first quarter of last year, which was an increase of 158%. And that was due to the higher production. Adjusted EBITDA was $11.4 million in the quarter, compared to $2.8 million in the prior year quarter, which was an increase of over 300% due to the higher production, and partly offset by lower prices compared to the prior year quarter. Net income was $7.9 million, or 22 cents per share in the first quarter, compared to a net loss of $2.5 million, or 7 cents per share in the prior year quarter. The netbacks were $43.67 per BOE, compared to $48.91, a decrease of 11%, and that was due to the lower prices compared to the prior year quarter. If you include the netbacks, include the hedges in the netbacks, our netbacks were $42.34 for the first quarter. And that's compared to $36.88 per BOE, which was an increase of 15%. And then our net debt, which we define as debt on the books less our cash on hand, was about $14 million. With that, I'll hand back to Wolf, and I'll take questions at the end if you guys have any additional questions.
Thanks, Gary. Yeah, I think overall, everyone can see that we had a great quarter, and things are just getting better and better as we go along. Some of the changes, the slides mainly the same. The one thing I'd like to point out is between last year and this year, our reserve report, the one from the end of 2022, our approved PDP reserves were up 10%. So we converted 10% more of our reserves into the PDP category just from those 5 wells. So with the wells we're drilling this year, we're looking to increase that further as the year goes on. And everyone knows kind of where we are. Production mix, 76%. And then our adjusted EBITDA, $6.5 million in 2021 to $25 million last year. And we have a projected 52 to 55 million range for this year, based on the 6 to 7 wells that we projected that we were forecast that we're going to drill. Like Gary said on the numbers, production first quarter was just over 3,100, almost 3,200 BOE a day. Proved reserves, as a reminder, from the year-end report, 515 million. These are all US dollars, right? And then proved probable of 700 million, while our US market cap is around 125 million. So pretty big disconnect, in our opinion, between what our proved value is versus what our market cap is. Same thing here, stock-wise, gone up to about 740 or so on the high, and it's fallen back down. So from our point of view, I think it's a bargain for us to be able to start picking us up here. There's a lot of uncertainty in the market, but also keep in mind that where oil prices are right now in the, let's say, the low 70s, our forecast is based on $75 oil. So we don't have a forecast that we put out there at a high oil price. And that's assuming, average annual production of 3,600 to 4,000 BOE a day is what we're forecasting. exit rate of 4,500 to 5,000 BOE a day, spending 44 to 51 million in CapEx. Hopefully leads to adjusted EBITDA for us of 52 to 55 million, as I noted on that previous slide. And we're keeping our debt down low in this projection here. Our net debt is between 16 and 18 million. We did get an increase in our line of credit this morning. We moved from 25 to 40 million. Bank of Oklahoma, which is our banker or lender, has done that. Obviously, that shows faith in first of all, the property, and second of all, we believe in the company and management and directors, et cetera. We're looking to keep our debt to adjusted EBITDA at well less than 1. And so that's the looking forward. One of the things that the debt does for us, gives us some cushion, gives us working capital side of things, because let's say you frack all of your wells in the last month of the quarter, you're going to use that cash flow from the next month or so to pay it off. You want to have some working capital on your books through the debt qualifies for that. And so that helps us out greatly. And it is extra than what we would need for what we're doing, but it gives us flexibility as well. Not that we want to increase our debt a lot, but it does give us flexibility if we want to ramp up further or not. Decision for the board to make, obviously, with our recommendations as we go forward. These are fairly well the same of what they have been. Just pointing out the Netherland Sewell PUD East curve and their risk curve here is a reflection of our higher IPs that we had last year, which were in the, between 700 and 900, so almost 1,000 BOE a day on some of those wells. From our 5 wells that we drilled last year, the average of those you can see here is in the 850 BOE a day range. The wells are holding in quite well as the year goes on. So we're quite above the type curve that Netherland Sewell did last year. And again, reservoir quality has been holding in there year after year, where the Netherland Sewell is giving us more and more credit every year for the PUDs as they go forward. We put a new slide out recently, which is the cumulative production slide that also demonstrates how well our 2022 wells were doing. We put in the Glen well here as well, the 16-2. This was one that we drilled about 4 years ago or so. And that has a ultimate recovery of almost 750,000 BOE, according to Netherland Sewell from the 1231 report, reserve report. That's in comparison to what Netherland Sewell is assuming that we're going to produce out of these wells. So again, we feel they're being conservative. We think we can do better. And the average of last year's wells show that we're exceeding these curves. Here's Netherland Sewell's curves. Here's the Glen curve. Here's the curve of the average of those 5 wells from last year. And even on the Glen well, you can tell that it was lower than what Netherland Sewell is assuming. But Netherland Sewell's curves here kind of fall over, whereas the Glen is still increasing. And if you take this out further, the Glen starts doing better and better than the Netherland Sewell assumptions. So as we drill our wells this year, we're hoping that we can continue to show wells that are extremely above or enough above here, and we're doing better than what they think, and we'll have better reserves and better results. Well-wise, here's the locations that Netherland Sewell gives us credit for, just to review those. Green is the proved locations, which is in that corridor region that we're looking at as well. And these are the red lines are our wells from last year. Our wells that we're drilling right now are, remember, from one pad, 2 Caney wells and 1 T-zone wells, and they're located right here in between, just to the west of our 8-4 well from last year. 17,000 acres, 180 total booked locations here, 60 proved, 63 probables. Infrastructure, as a reminder, everything's in place. As soon as we see gas coming out, we go down the gathering system that's in place. We build all that out beforehand, have tank batteries in place. So from an environmental point of view, we're not flaring gas. We're having the gas come out and then starting to sell it as quickly as possible, which is very fast for us, or in general for the business. 82% of our total acreage is in the reserve report from Netherland Sewell. And we believe that some of these proved locations are going to increase further as we step off to the east over here and hopefully out to the west. 6 wells per section, by the way, for all those. To point out everything, our wells were primarily all in the Caney here. We did have a few wells that we tested in what's called the T zone out here. And as I mentioned, the 3 pad that we're drilling 2 wells in the Caney and then 1 well in the T zone. And we put a new slide in here saying why we did this. So why add the T zone in when you have all these Caney wells to drill? Excuse me. And really what it is we had tested the T zone. It produced oil and gas. A number of the wells were understimulated. Actually, all of them were, just some more dramatically than others. And the last T zone well that we had a good IP30, but a hard decline. So what's changed since then? Well, first of all, on how much proppant we put in per foot. And you can see in these early wells in the T zone, we're not putting very much proppant in per foot, considering now our current frac design is about 2,000 pounds per foot. So the best well we had in the T zone, which was the Hartgraves 5-3, was around 1,000. So half of what we now put into our fracture stimulation. Plus, when we were doing these fracture stimulations, we were using a lot of gel. We were doing linear gel and then a cross-link gel to finish off each frac stage. And now we're using a HDFR, high friction reducer fluid, which is cleaner and is not gel. It also breaks up more rock closer into the wellbore. And so we think that with these new fracture stimulation techniques that we're using successfully in the Caney, T-zone is kind of a similar rock, but it is separated from the Caney, that we can add well locations and make economic wells in the T-zone. So that's what we're looking to prove. So adding one in here gives us, 6 months plus of production for Netherland Sewell, hopefully the next year, to increase those reserves, or add those reserves, I should say, to our reserve report. And it also gives us well more locations based on that as well. So it increases reserves and increases well locations for us.
If I'm not mistaken, the T zone is pretty much spread across all 17,000 acres, correct? It
is. Thanks for pointing that out. Yep. So, and we have good control over that as well because of all the Woodford wells we had drilled earlier in our previous generation before we sold that to Exxon back in 2013. So we have well logs across everything. And as a reminder, we had 12,000 acres back then that we sold for $147 million. And it was 80% gas versus, we're up in the 70 to mid 70s on oil now. Enterprise value, obviously not including any T-zone potential. We're looking at ourselves on the comparison between what other companies are trading for that we consider our peers out here. And we're trading well below that on enterprise versus a NAV value. Same on the 2P number. The first one was the 1P number, well underneath what everyone's trading for as well. Operating netbacks, much higher operating netbacks. So it seems like we should have a premium to others versus being at a deficit. Everything is going well for us. And on a per share basis, our reserves, work out to, almost $20 a share Canadian and $27 Canadian on a 2P number. So, we have a lot of room to run. G&A had been going down year after year, and our OPEX per barrel of oil equivalent is on the low end. And if you look at this, the ones that are even lower than us are mainly natural gas producers. So their lifting costs are less than where we are. Goal going forward, continuing to use our cash flow in order to drill wells. I mentioned debt from time to time. We may use that, but the goal is to be down in the 16 to 18 million at the year end. And we don't see anything different from that at this point in time. We are currently looking to, drill here the 6 wells this year. Cash flow, where cash comes in as far as where production comes in and as far as where the oil prices are, that'll determine if we can drill more wells or not. The bank loan could increase that as well, obviously, with that. But right now we want to see how this first 3 pad goes, and then continue with the program as the year goes on. This slide we get a lot of questions on from time to time. They're like, okay, is this your absolute plan? This is not our absolute plan going forward, but it does give people an idea of what this is worth. This is a arbitrary number that we picked of saying, 4,000 BOE a day. We had one in our presentation last year that was, okay, what does 3,000 BOE a day do? We obviously made better wells, had higher cash flow than we had even forecast last year. So we said, okay, 4,000 BOE a day. What does it take to get us there and to hold us there? Because it's important how hard these wells are declining, et cetera. How many wells does it take to keep this kind of cash flow up in a $75 oil price scenario? And, you see here in our modeling, it shows 2 wells in 2024, 3 wells in 25, 3 wells in 26. So somewhere between around 3 wells holds cash flow here at, or production at 4,000 BOE a day. That's the cash flow there. And, we could be making a whole lot of money here on a year by year basis. What we decide to do with that, and we, meaning management recommendations to the board of directors, is up for discussion later on this year, whether we increase our production further, whether we start, paying dividends or doing share buybacks if our stock is too low. That'll be something that we determine going forward. So this is just an illustrative example. And considering we have 35.6 million shares outstanding, you can see that in US dollars, over $1 share US is very possible based on just this scenario of 4,000 BOE a day. Probably drill more wells than this, but this gives you an idea for what it is going forward. And with 60 proved locations, not including the T-zone, gives you a lot of running room for a lot of cash flow for a lot of years, assuming all these things happen the way we have them laid out here. And that's really the end of it. Guidance is what it is, 60 to 70 million, 65 to 70 million in revenue, 50 to 55 million of adjusted EBITDA, and the guidance of 3,600 to 4,000 BOE a day. We will address this going forward after we get the results from this first pad and seeing where the price of oil is. Then we may adjust it to drill additional wells as we see fit. So with that, we'll open up to any questions or any other comments or something that I left out.
Well, sounds great as always. But I do have a few questions. So again, I think, the increase of the bank line, which I'm not seeing from any other oil and gas companies, especially given the regional banking crisis that's going on, really speaks to the quality of your reserves and the management team. They had made you hedge, I think it was 75% of your production historically.
Yeah, 75% of their projected oil forecast. Yes.
And so what are the rules around then? Yeah,
so we did get that modified a bit. So it depends on utilization of our line of credit. Mm-hmm. So at a 50% utilization, we have to hedge 50% of our production for the first year of their deemed oil portion of the production, by the way, for the first year, and then 25% for the second year. If we go above that, then it would be 75% for the first year and 50% from the second year, which is a good improvement from where we were of 75% for everything for the next 2 years is where we were in the previous generation of this.
So they must have a lot. Every indication is they have a lot more comfort as you've gotten more well data, I would think. So
yeah, and actually the value has gone up as well, right? So banks are still being conservative. So what I would say is if we were where we were 5 years ago, let's say, in bank lending, et cetera, we'd probably have a higher limit right now.
Oh yes, it's completely changed. That's for sure.
Right.
Is there any restriction on using your debt for buybacks?
So yes, right now, all of our cash from the field has to either go to paying down debt or to being used in the field. So as our cash flow grows, that's something we can address in the future. Our main look this time was giving us a little bit more cushion for flexibility on the line of credit size, and then also on the hedging, so that we weren't having to hedge the full 75%.
And let me just add something. Our current utilization on our debt is under 50%, just so everyone knows where we're at right now.
Right. Good point.
And
we're about 18 million out of the 40.
Okay. So just on your netbacks, given you had a lower price realization, but you still had stellar netbacks, I mean, a lot of that was to do with economies of scale as you increase production. So your OPEX was down fairly substantially from, I think, 9 down to 6. Is that right? 950 down to 604. Do you see more improvement happening there, or are you kind of stalled out on the OPEX side? Even with more production?
Yeah, it'll fluctuate a little bit. But yeah, it's basically as we put more production on, our fixed costs stay the same. So I don't expect a dramatic decrease from here. But if anyone's modeling this out, use what we have there, then I think that's good. So.
And what's your sensitivity, cash flow sensitivity for every dollar change of WTI?
You know what? I'd have to figure that out. I don't have that off the top of my head. So
I'm sorry to ask you that.
It'd be 3,600 to 4,000 BOE a day is our average, right? So we'd be, for every dollar, we'd be, a little less than 4,000 a day cash flow less.
Yeah, roughly.
Yeah, a little less than that, but
we can model that and get back to you.
Yeah, I just curious because people ask the question nowadays with the volatility that we're seeing in oil prices.
I mean, one of the things I point out is, like I mentioned, our forecast is based on $75 oil. Oil's trading right now, so let's call
close to that.
70s, close to that. Yeah. And then when we first started kicking off our drilling program in 2022, into late 2021, we were modeling everything at a $65 oil price. And we were modeling much lower productivity per well than we're getting right now.
Yeah. So you're pretty conservative across all levels right now.
Correct.
So given the declines that you're not seeing, well, you are seeing declines, but they're better than expected. And you have a lot more production history. I mean, you have almost a year on 2 wells and close to 5 months on the 3 that you drilled at the end of last year. Is there anything, and now, and you're just in the process of finishing your 3-well pad. Is there anything you would tweak, you think, from the completion technique, or you think it's working pretty perfectly?
Yeah, no, I think everything's going well. There's not much we would change. We don't want to mess with something that's working well. I mean, maybe we'll do some small minor adjustments, but nothing even worth speaking
about. Nothing major. You think you pretty much perfected it? Okay.
Yeah, it sure looks like it. So we're always open to new ideas, obviously, which we test out carefully, but that's how we got to these completions as well.
When do you think you should be done drilling soon, the last Caney well, right?
Yeah, and so we should be done drilling here soon. Casing should be in the ground here, and then we're just waiting on the frac crew to be done with their previous job, and hopefully here near the end of May, maybe the third, hopefully late third week-ish, that they're moving in and we're fracture stimulating. And it should be 2 to 3 weeks of fracture stimulation, roughly, because we're fracture stimulating all 3 wells at the same time.
Maybe you could.
I know there's some questions about that.
Yeah.
Right. So what that really means is you do a stage in one of the wells, then you do a stage in the next well, and then you do the stage in the next well. And that means, you perforate a well. Normally a fracture stimulation, for those that don't know much about it, there's 33, 34 stages in each of these wells that we fracture stimulate. So you perforate an interval, and then you pump in the fluid along with the proppant. And then you normally move to the next stage. So in this case, when there's 3 on one pad, you'll do 1 in one well. And so as you're pumping down and doing your frac job in your first well, you can be perforating and setting the plug in the second one. And then when you're fracture stimulating the second one, you can be doing the same thing on the third one. So you're much more efficient by doing it on a pad rather than doing one whole well, because you're waiting on different things. Otherwise, you can't be perforating or pushing down your plug as you're obviously fracture stimulating. And if you're only doing one well at a time, so it's a lot more efficient. So that's why it's 2 to 3 weeks. roughly to get these done.
So how much does that drop your costs by, or does it?
It's taken into our AFEs. We're hoping that I don't have a dollar number on it. Probably, I'm going to guess 100,000, 150,000 maybe per well, but don't hold me to that number. It's significant, and it's just time wise too.
Well, and I also was looking this morning that rig utilization's dropping in the U.S. Do you think you'll see costs come down a little bit as far as you're at 7.2 per well right now? Do you think?
We're hoping that 7.2 is conservative, but we'd like to leave room for, things don't always go perfect. So you want to have a contingency in when you're planning for these things.
For sure.
So we're hoping, because they're pad wells, that we'll be able to knock that well cost down further. And we have seen, casing prices have kind of stabilized down from the peak a bit. And hopefully, rigs and services, et cetera, will calm down a little bit as well. I don't see any price increases from here, but hopefully.
No, I think it's, anything. But yeah. Now, you've kind of addressed this, really, a question from the audience. I think to accelerate your drill program, you're going to want to see how well these 3 wells perform.
Yeah, we want to have a feel for what our cash flow is from these wells, right? So where they're a little tighter spacing. So we've taken a conservative view. Our forecast is not at the average of what they did last year. It's actually about 25% less. And it's, IP wise, they're around what Netherlands Sewell assumes. But 9 months out, we're doing a little better than what they assumed. And that's our conservative case. So hopefully we're at least at that, and then we hit our forecasts. And hopefully we're better than that, and we'll be exceeding them.
I know you seem to be hitting on all the cylinders, that's for sure. You did have a well, older well that needed a workover that was off stream. Is that back on stream now?
Yeah, we did a workover on it, and actually it's less than a 2-month payout that we got back on that, even at these prices. So it worked out well. So
did that increase? You won't answer this question, but last
it's 100. It's about 100 BOE a day. So, but it was down to making, maybe 10 or less. So it was very worthwhile, and it's been hanging in there well for 30, 45 days now.
Okay. Let's see. Is there any reason why, with additional line, you couldn't drill and complete 6+ wells in the second half of 2023? And then, I think until you get the results of these wells, it's hard to really put up a shareholder plan together as regarding buybacks or dividends, et cetera. You're
right. No, exactly. We need to see what the cash flow is and where oil prices settle out, right? That's all related. Yeah. Productivity from the wells plus oil prices is what our cash flow is. We don't want to take on a huge amount of debt. Once we are comfortable with, these pad wells, how we're drilling them and how they're producing, then we can potentially look at increasing what we're doing. So the rig right now is scheduled to come back in July sometime.
Okay.
To drill the next pad of this one will be a pad of 2 wells. And so, we have things moving forward, and then it'll be cash flow as far as if we can increase it, but it'll take us a couple of months to figure that out.
Okay. Let's say we do see a turnaround in the macro front. Would you get another rig going? Or do you think
I don't know if we'd need another rig. We just have a little bit more of a continuous program, but it's still based on cash flow, right? So it's a timing thing. So but hopefully more, being able to drill more wells back to back. So until you can get to the stage where you're drilling wells on a continuous basis.
Okay. So you've got 2, you'll start drilling, let's say July, and then another, hopefully 4 to 4 from there, 3 to 4 from there.
Yeah, we'll be at 5. So, realistically, or according to our budget, we'd only have 1 more after that, right?
I know. 1 to 2. I'm pushing you. So, fine. If things were looking better than they are right now.
Yeah, no, exactly. The wells perform well and everything else, then we'll make sure we can get some additional equipment, and we'll be set up for it. So we're doing all the prep work so we can increase when we see it.
Okay. And one person wants to know if you will give your April production number, but I don't think you will, given you haven't released that.
Yeah, I can't let it out just on a on a webinar, no events, but it has to be in a press release so we don't get our hands slapped.
Okay. One question: does management run any forecasting scenarios using its recent 5-well results from last year as the drilling type curve?
We have. It's obviously better.
So, you just haven't given them
it looks yeah, exactly. It obviously looks a lot better, and it would be fantastic if we can do that. So I would look forward to that. But we don't like putting out numbers that we don't feel very confident that we can hit. So right now we have to kind of use what that discount on that what we were doing last year are.
Yeah, I mean that's I mean there's a few things up in the air. So until we can answer those, it's really hard. I mean, we have to give you a couple months to readjust your program. I guess.
Yeah, we want to be prudent about everything. Right? That's how we survived as well. So
exactly.
That's how you survive downturns.
Well, that's the whole thing. And I mean, who knows what could happen here in the next couple of months. And so I'd rather see you prudent than blowing your brains out.
Yeah. And that said, actually, in downturns, that's what happens. People, in general, the industry, oil futures traders panic. Oil prices go down further than they should. Even in recessions, you don't have historically, you don't have a huge demand hit.
You don't, but the complex trades like you are getting a demand hit. Yeah,
exactly. So, if you don't have that doesn't happen, then you have a hit, but it recovers pretty quickly. So that's kind of what we're hoping that happens this time through. Global inventories, as much as the U.S. inventories were up this morning, we also had almost 2.9 million, I think, release from the SPR again. So that kind of adds to that. And overall, I saw some stats here. Global reserves are still dropping for global storage. So I think we'll be all right.
And we see any pickup from China. I mean, that's that will be a game changer for sure. And then again, also, how you plan the rest of your program will be subject to all the T-well results T-zone results as well.
Correct.
Yeah. Okay. Yeah, we're trying to get independent research coverage. Someone asking the question. We're doing our best. For those investors, we are doing some marketing next week in person. Getting some new eyes on the story, I think, will be helpful because again, it's still an under-known name, really, and undercovered. So we're trying our best, and unfortunately, you don't need money, so that doesn't entice many brokers to cover sometimes. I mean, I think you're doing everything right. I'm a happy shareholder, I mean, I think you've just been taken down with the rest of the complex. At what point, though, does buying back stock make more sense than drilling?
That's something
I'm sure you've run the numbers.
We'd have to get approval from our bank for that as well.
Yeah.
Right. So we do need some more cash flow coming up so that they feel comfortable with that as well. And then, it's a number exercise at that point to see what makes more sense. So right now, we believe our returns on our wells we're drilling are fantastic. So, that still will probably add more than doing share buyback, but, we'll see what the next late in the year shows. Hopefully we're a lot higher because people understand we're a bargain now.
Well, you really are. And again, you didn't have a ton of production history on a big part of your program from last year. So there's going to be a lot of changes to your reserve report this year. And I think you're probably light on your average and exit production, but, you can't say anything until it's all on the come. There's a lot of catalysts coming here over the next, 2 to 3 months. So, and, we'll be keeping our eye out for that. And like I said, doing some more marketing, and hopefully the macro starts to work in our favor a little bit better.
I agree.
If there's anything I've missed, please, have I missed anything?
Not as far as I know.
Right. If anyone has any further questions or would like to meet with the company directly, I'm happy to arrange a one-on-one. Thank you very much for your time, gentlemen. Again, keep up the good work, and we're watching closely.
Sounds good. And thanks everyone for joining.
All right. Thank you.
Thank you. Thank you, Jessica.
Okay. Bye.